Good evening, friends. At the onset, let me begin with wishing you all a very happy new year. Hope you all are well and doing fine. As we step into 2023, it's imperative that we also take stock of what has happened in 2022. And as far as fixed income markets are concerned, it has been one of the most turbulent year to go with as far as interest rate movements is concerned. If you all recollect, beginning of the 2022, rates were low, liquidity was benign, and things were very much under control. And suddenly you had this Ukraine-Russia war, geopolitical tension, and things took U-turn, leading to spiraling commodity prices, its impact on inflation, and eventually rates moving northwards at a very hectic pace. And in a very short period of time, we saw yields moving as high as by 1 or 2% depending upon the maturities. And therefore, as we entered or ended 2022, what we find that yields are at near all-time high, or it's high in this current cycle. And therefore, the question on the mind of investor, what next as we step into 2023? But before we get into that, what we find very interesting is that this rise in interest rates presents a set of opportunity for investors is concerned. What we find also based on our previous experience, that investors tend to invest in debt when the past returns are very attractive and tend to avoid when past returns are not so attractive, which should be exactly opposite of that. Of course, the rise in yields have led to MTM losses, and therefore past returns are not looking that great. But at the same time, what you get in terms of debt return is what you are offered, what is the YTM or what is the yield on the product at the current juncture. And that's what we find very interesting. So today we have with us Shobhit Mehrotra, our head of fixed income, who will take us through what do we feel can happen to fixed income market in 2023. Where is the opportunity for the investors? As I said earlier also, now as YTMs are very attractive, but of course, there is always going to be dilemma that whether interest rates will move further or will stabilize or likely to move lower. So depending upon that, the opportunity also is there. But there is one more offering which is right now available to the investors. We are out in the market with the NFO of, as you can see, HDFC Long Duration Debt Fund. So it's like yield curve which says you have in debt work from a one-day investment to a very long maturity. So this is the longest maturity which is permitted to AMC by SEBI. So we are offering that which is available to us, and what we think about this opportunity, that also Shobhit will dwell upon in his presentation. Also with me is my colleague Ram Kumar, who will be moderating the call with me. At the end of this presentation, after the opening remarks of Shobhit, if you have any questions, please feel to ask, and we'll be more than happy to get them resolved for you, get them answered for you. So without much ado, over to you, Shobhit.
Thank you, Ashok. And thank you everyone for joining in on this call today. Without taking any further time, let me first start with talking about our new product. And in this presentation, we have three parts. In the first part, we'll talk about India's growth story and how that is going to play out over the years and what it means for the bond market. In the second part, we'll talk a little bit about the importance of asset allocation and how that can help investors in creating solid investment portfolio. And in the last part, we'll touch specifically on this product of long duration debt fund. So if you look at the long duration debt fund, it's a very simple concept, and any investor, whether he's retail investor or an institutional or a high net worth investor, any investor who wants to create wealth over long periods of time needs to have a strong core. So with this product, with this fund, we think uh, investor will get an opportunity to build a strong core or a strong foundation which can serve them well for long periods of time. Now, if you look at how India has been doing, India's growth story over years, if you see whether it was the 80s or the 90s, the big achievement of India has been that we've got consistent growth, whether it was 80s, 90s, the 2000s, or even the last decade. The consistency of our growth story has been there irrespective of the multiple shocks which we have seen, whether it is civil strife, whether it is global issues, whether we've had any kind of global turmoil or disturbances locally. The consistent growth story of India has been there from 80s onwards. In till 2000s, the growth for India was around 15%. And in from 2000 onwards, the growth has shifted a little lower. But the big achievement is that from 80s to 2000, it was the inflation which was there was around 9%. And the shift in growth downward, when the nominal shifted from 15% to 12%, the shift happened because inflation came down. Inflation from 9% of or even higher of the 80s and 90s shifted lower to between say 5 to 6%. Now this has huge implications for the bond market. Going forward, as the Indian economy increases in size, and if inflation comes off from a range of say 5 to 6%, instead of that, if we move downward towards 4.5 to 5, that would have huge implications for the bond market. Now, let us see where the growth story is likely to play out, across other major countries. If you look at this chart on the top of the screen, no other country is likely to show a growth rate of above 6.5%. Even countries like China, Indonesia, which are expected to grow in the next 5 years, are likely to clock only around 4.5 to 5% growth. But India's growth at over 6% stands out, and the reason for that is mainly as we show in this chart on the bottom of the screen on the left side, is the huge demographic advantage. So the demographic dividend of India, where our working age population is over 60-65%. And today, in the global population of working group of people, India and China stand out. Today, China has more share or higher share of working age people in the global pool of working profile of population. And India overtakes China in a couple of years, where India will contribute a larger share of working group of people. So that is a key determinant for driving growth in the future. The other aspect would be, as we show on the bottom right side of the screen, the chart shows the macroeconomic environment in India. Look at where India's total debt to GDP is. Total debt to GDP of India is just about 170 odd percent, which is significantly better than most other developed world, which are all at above upwards of 250% plus on total debt to GDP. So India has huge potential to invest in its infrastructure. and that would bring growth going forward. The other drivers would be, we all know what the major multinational companies are planning to do post-COVID. The disruption which was caused because of COVID, especially out of China, has introduced a China plus one strategy across the global manufacturing world. Now, in this, the government's PLI scheme has done exceedingly well. There are 600 plus companies which have shown interest in the PLI scheme. In the electronic sector, PLI has done exceedingly well. If you would see how the growth of mobile phones has happened out of India, from 2017 till in the last 5 years, from 2017 to 22, mobile phone exports out of India have grown 7x. So these are the kind of developments which have taken place, which are slowly making an impact for India's growth story. We have seen post-COVID in the last couple of years, corporate balance sheet and the bank balance sheets are in a significantly better shape, especially after getting rid of the NPA cycle in the previous round. The cleanup has put the corporate India in a strong position to take the next capex forward. The government's push on infrastructure and housing, the strong consumption, which is driven by the large middle class. So all these drivers are in place to ensure that India growth story plays out. And if you see, Goldman Sachs came up with a, they coined the term BRICS, and they had come up with a very interesting report which said the path to 2050. Now, this was done 2 decades back. And once again, they have come up with an update of this economic report, which, shows the likely size of various economies from here till 2075. Now, it's a huge achievement for India that from in the 2000, our economy was ranked 13. And in 22, last year, India's rank in terms of its size of its economy has already overtaken UK to be ranked as the 5th largest economy. By 2050, India is likely to take the 3rd rank in terms of size of economy. So consistently over the years, from 80s to 2000 to, even last year, and by 2050, India's rank in terms of the size of its economy is showing, steady improvement. And it will be a great achievement or proud moment for the country when, we will get to the position, I think it will be by 2046, that we'll get to a size of becoming the 3rd largest economy in the world. Now, what does that mean in terms of rates? Normally, it's been seen that as the size of the economies goes up, as if you can see in this chart here, the size of US in 1980 was where roughly India is today, around just say 3 trillion in terms of size. And by 2022, the US economy has grown to nearly 25 trillion, which perhaps India will become, somewhere around that 21, 22 trillion by 2050. So we've seen that, if you see this chart, as the size of US economy has grown from say 3 trillion to 25 trillion, yields have gone down from 12% to 3 or 3.5 today. So we've seen major move on the yields, whether it is US, whether it is South Korea, Malaysia, even India, from 1998 or 2000 onwards, as the size has increased to 2022, our yields have come down, a significant number. We were in double-digit 12% odd yields on the 10-year, which has come down today to say roughly over 7.3. So Generally, that is the trend. As the size of the economy goes up, as we move up the economic ladder, the yields move down. Now, where are things placed today? I think we all know last year has been a very difficult year for the bond markets across the world globally. We've seen in the US rates growing from 0% to 0 to 0.25 range, went to 4 quarter, 4 half. So large amount of rate hikes have already happened because inflation was at a 4 decade high. And thankfully, in the second half of the year, commodity prices came down, supply chain pressures eased, and there was, that brought about a slowdown in the global growth, which has brought some degree of moderation in the pace of rate hikes by central banks. And going forward, by the middle of this year, by maybe May of 23, the expectation is that most of the rate hikes will be behind us, and we are in the last leg of final rate hikes, whether it is by the US or it is by even India. Now, if you look at where our inflation is today, one can clearly see, as you can see in this chart on the left side, inflation momentum even in India is slowing down. The number of items where prices are increasing by more than 0.5% per month, that is clearly coming off. We are seeing WPI coming down. We are seeing the easing in the strength of US dollar. We are seeing commodity prices coming off from peak, and that would perhaps allow RBI to maybe consider one last hike of 25 basis points, take the terminal repo rate to 6.5, and thereafter go for a pause. Now, all these rate hikes in the last year led to a significant flattening of the yield curve. As we went from 3.35 on the overnight rates to a repo rate today of 6 quarter, we've seen shorter end yields rise by almost 300 basis points. But longer end, if you see in this yield curve chart, which is there on the screen, longer end yields have moved up only by 30 odd basis points. So now the entire curve is above the RBI target range, and therefore our view is that typically it is seen that yields tend to peak out before the peak of policy rates. So even in the US, the expected Fed peak rate is 5%, but the 10-year today is still trading below the Fed rate and somewhere around 3.5, 370 band. So even in India, even in the past, we have seen that the peak of the yields of the 10-year yields happens perhaps even before the peak on the repo rate is reached, because markets tend to price in the future rate moves. And if the markets get a sense that perhaps we are definitely still looking at the last rate hike happening sometime in Feb, then markets will not wait for that to play out, and yields can peak out even before that. Now, let's move on to the importance of asset allocation, and how by regular investing, investors can create wealth. I think asset allocation is at the heart of investing. It is one of the most important tools which investors need to have if you want to create wealth over long periods of time. And long duration assets especially fit in well at the core of this asset allocation. So when I say long duration assets, I would cover both, whether it is large cap equity or long duration debt. To our mind, I think that sits at the core of investors' asset allocation. And I think what Morgan Housel has said on this fits in quite well. How long you stay invested for will likely be the single most important factor determining how well you do at investing. So it all boils down to how what is the holding power and how much you are willing to invest for long periods. That would be the key in determining the performance or the overall investment outcome. Now, if you look at specifically long duration assets, I think whatever be the age profile of investor, whether it's a young investor or a middle-aged or a seasoned investor, typically, if a long-term debt as asset allocation is being done, then perhaps a long duration debt fund fits in well at the core, and that would yield good results. Here we've tried to indicate that if a young person starts investing just with a investment amount of say 10,000 rupees per month for 20 years, this gives you an ability to withdraw 3 times that amount, i.e. 30,000 rupees per month for 20 years, and still be left with 43 lakhs. So the benefit of starting early on investing is clearly visible here. Even when somebody starts in the middle age, say somewhere around 40s, with an investment amount of 30,000 for 10 years, one can accumulate, a corpus of almost 45 lakhs. So these are the, good numbers which one can work with, whatever investment amount one is comfortable with. This is like a very flexible product wherein, investor can decide the investment period, and then, somebody can wait for a certain while and then decide on the withdrawal plan. So whether one assumes a return of 7% or you assume a return of 6%, the overall performance, overall size of the corpus is still fairly decent over long periods of time. Now, how does this kind of a fund stack up with other available options? I think the key benefit here is of the flexibility, tax optimal efficiencies. So these are the I think pretty much known advantages which one sees across other available options for investors. Finally, when we move on to the specifics of this fund, I think one thing which we would want to highlight is the current positioning. The product, as I said, is very simple. We are looking at investing in only government securities at this stage. The only thing which has to be done is we have to ensure that the duration is greater than 7 years. So we intend to do this by investing in around 30 years of residual maturity GSEG, which are maturing, say, around 2050 or between 2050 to 2055. And the idea is to go in for what is well known in the industry as a roll down strategy, but ensuring that the minimum Macaulay duration of 7 years and or higher is maintained. Now, this is the positioning as of now. Over the next several years, my sense is at least around 7 to 8 years, we can continue with a similar profile. But at some stage, if we see ourselves get approaching the Macaulay duration of 7%, we will come back and share the revised positioning at that point of time, and let investors know what makes sense, how do we tweak our investment strategy, and given the nature of yields and given the yield curve positioning, we can decide at that point of time what would be most optimal to do. As the duration is high, the preferred investment horizon here is long, very long, at least 5 to 10 year plus. And this is the fund which investors can use for long-term wealth creation. I think the benefits are very much evident in terms of providing a hedge against expected inflation. The flexibility is well known. The inflows and outflows are in the investor's hand. There is by remaining invested, the tax can be deferred. The tax payout will happen only when the redemption happens. So these are the big advantages. I think another big positive is that not many products offer you the flexibility to get an exposure to longer end of the curve where the yields are the highest. And here is the fund which allows one to do that. So in terms of product positioning, I think it is because of its duration of over 7 years, it is placed at at the extreme right or on the longest end of the curve, where we have the various products starting from overnight to income or medium to long, and this fits in at the top end of that. To conclude, I think India's structural growth story is pretty much well known. I think India is likely to be in the top 3 economies of the world. And we have seen that as countries go from low income to middle and high income, when your per capita income rises from somewhere around $3,000 per person to over $10,000 per person, typically the supply demand of goods and services is significantly improved, which means inflation is not very high, and which has huge positive implications for bond yields in those kind of environments and countries. Now, how are things placed today? I think globally, interest rates, rate hikes in the last year have been of a very high order in a very short span of time. We are entering the last leg of the global monetary policy cycle. The intensity of future rate hikes is not going to be as much as what we have seen in the last year. We expect even Fed or even Eurozone or to moderate the pace hikes, and peak of the rates would be reached somewhere around the middle of the year. In India too, we are getting closer to the peak. I think most people are looking at 6.5 as the peak repo rate. Dollar strength, which was prevalent in the first half of last year, is easing since the end of last year. It has turned, and therefore the pressure on the currency is significantly less. Last year, the shape of the curve flattened because of overnight rates and shorter end yields rising. And we think that now we are getting to a point where even longer end yields, perhaps not as high as the peak levels, but are just a little bit lower, significantly better than the low points which we have seen on the 30-year bonds in, say, February. In the February, the 30-year government yield was somewhere around 710. From 710, we are today at 740 plus. So government bond yields on the 30-year segment, which we are targeting for the long duration debt fund, have moved from the low point. They have come up above 740. And we think this is a decent enough point for investors to consider investing in a long duration fund, even though people may add or come in with a smaller allocation to begin with. Now, what is the key risk, which I think one also needs to note, is that perhaps structurally, if inflation remains high in 23, then the markets could be premature in pricing in the end of rate hike cycle, and that is the key risk. And hopefully, inflation trends lower, and we don't see elements of structurally inflation remaining high. And therefore, in conclusion, we feel it's the right environment, right time to look at starting to allocate towards longer duration in this year. And I think this is a fund which investors can use to make a start. So with that, I'll stop here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.